So now we're going to talk about another standard, which is fair value management, Ind AS 113, right? And why do we need this standard, right? So when you look at again Ind AS, fair value as a form of measurement is all pervasive, right? Now, what does that mean? That mean is that there are two ways you do accounting, right? One is a recognition, and then second is the measurement. Now, when you look at measurement, it is the historical cost or fair value. And then the relevance of fair value is also at two levels. One is at initial recognition, and then it is at subsequent recognition. So when you look at the Ind AS, and there are multiple standard in Ind AS, they talk about fair value both at initial recognition as well as subsequent recognition. And of course, at several places, you do initial recognition and subsequent recognition is at historical cost. However, these standards do not provide a lot of guidance on how do you apply fair value, right? So in terms of what are the measurement principles when you actually talk about fair value? How do you go about the fair value application at a principle level? And that is where Ind AS 113 in a way has been written to provide the conceptual framework around fair value. Okay. Ind AS 113 in a way doesn't prescribe that where all you need to apply fair value. But what Ind AS 113 says that if you were to apply fair value, and if there is no specific, so to say, exception to that rule, you should look at the principles of Ind AS 113 in the context of determination of fair value. So the definition of fair value, which is provided in Ind AS 113, is in a way being replicated in multiple other standards of Ind AS. And the application of that definition is what is covered in this standard at a great degree of detail, right? And that is what we will try and understand and cover and explain, that what is fair value. And I was kind of talking about this in one of the forums, and I said fair value is actually very unfair, right? And today what you believe is fair, in a way, let's say you want to buy a property, right? And the property today, the market value is 100, and tomorrow the market value is 120, and then or maybe 80, right? So fair value is actually relevant again at a point in time, right? And it is supposed to change. It is supposed to change depending upon changing facts, changing not fact, but changing circumstances. Let me put it that way: changing circumstances, time, etc. Relevance, right? As you could have imagined, during the pandemic, the valuations of assets got suppressed as if there is no tomorrow. And then subsequent to the pandemic, though we are still in pandemic, we're now seeing exuberance, right? We're seeing that there is a significant demand of a lot of different types of assets, and as a result of which there is a significant increase in amount and valuations of some of those assets, right? From that perspective. So what in a way we will do is help you understand what's the relevance of the standard, why do we need it, what's again the examination pattern, and some of the principles, and with some of the examples, right, as to how do you apply them in practice. Okay, so how to determine fair value as per Ind AS 113 when required by other Ind AS? So this standard doesn't tell you that where to apply. It simply says wherever you need to apply, this is the framework and the principle and the guidance. What are those valuation techniques which are prescribed in the standard? So there are in a way three valuation techniques, which is a market approach, in a way income approach, and cost approach. These are the three ways in a way you look at evaluation techniques. One is a pretty much simpler, if it is a quoted or unquoted, right? So this is, and then you have two overall principles. So to say, is it a quoted or unquoted, right? If it is quoted, then anyway you don't need any of them. But if it is unquoted, then you get to this scenario that how do I now, for an unquoted asset or a liability which I need to fair value, how do I figure out the fair value, right? How do how to fair value for non-financial assets, liabilities, and an entity equity, own equity instrument, right? So how do you fair value a non-financial asset or a liability or an own equity instrument? What is a non-financial asset or a liability? Financial asset or a liability is something which originate out of an arrangement between two parties, right, which results into a financial asset for one entity and a liability or equity of another enterprise. That's the definition of a financial asset or a financial liability, right? Or that's what the whole thing about financial instrument, something which originate out of a contract between two parties, which results into a financial asset for one and a financial liability or equity of another enterprise, right? So all monetary assets and liabilities are financial assets or liabilities, and non-monetary asset like equity shares are also financial assets in a way from that perspective. Fair value hierarchy, right? What's the fair value hierarchy under various levels, which are three levels which are out there, right? Level 1, level 2, level 3. So we're going to talk about that: level 1, level 2, and level 3. What are those fair valuation hierarchy? What disclosure information for fair value needs to be made? What all we need to provide as part of disclosures from a financial statement perspective is also what we will aim to cover from that perspective. Okay, so broadly, why we need the standard, how do you apply the standard, what's the meaning of fair value, how do you value fair value in the context of non-financial assets or a liability, and what are those measurement techniques, and what disclosures we need to make is what we will aim to cover. Examination trend, the couple of times all of this in a way been examined. So when you look at again in November 2018 for 5 marks, and when you look at in November 19 for 8 marks, in May of 2016 for 8 marks, in a way from that perspective. So it'll be good to understand, right, the application of this standard, because this is something which is looks to be important, and it's easy. It's not a complex standard. I think there are not too many rules which you need to remember, and at least the questions which I saw, I think they are very similar, and not complex principles. Okay, it's just that you got to apply yourself, keep those definitions in mind, understand those definitions, and then I think you will be good in a way to apply the principles in practice, right, or apply the principles from an examination perspective. So let's talk about fair value. What are the objectives here? Objective is to define fair value, the single Ind AS framework for measuring fair value, and require disclosures about fair value measurement. So single Ind AS framework, and require disclosures about fair value framework, right, from all fair value measurement perspective. So what's fair value? It's a market-based measurement, not an entity-specific measurement. So whenever you think about fair value, it is like, I may believe that I have this property. I may believe the fair value of this is, let's say, 100 rupees, right? But that doesn't mean anything, okay? I may believe it is 100 or 1,000 or 10,000 or 100,000. What is relevant is that what is the value, what a counterparty who is willing to put money on the table is willing to say, look, this is the price at which I want to buy this asset, okay? Or this is the price at which I can exit out of this asset, or I can transfer this liability, so to say. So if I have a, let's say, if I have a, car, right, at what price I can sell the car? I may purchase it for 100 rupees. That's not the fair value anymore, right? At what price I can sell this car? So if today I can only sell it for 50 rupees or 50,000 rupees or 5 lakh rupees, that's the fair value, right, of that car. So I think essentially the const, and then what is it a counterparty marketplace participant is saying, not me, right? What's a marketplace participant is saying is that is what is fair value. So fair value is a market-based measurement, not an entity specific measurement. From that perspective, it's a market-based measurement, not an entity specific measurement. What's the objective of a fair value measurement? Is to estimate the price at which an orderly transaction to sell the asset or transfer the liability would take place between market participants at the measurement date. Between market participants at the measurement date. All right, that's important. Between the market participants at the measurement date at which you sell the asset or exit the asset or transfer the liability to estimate the price. That's what we are looking under current market conditions. Under current market conditions. So that's the objective. Now, in terms of the overall scope of the standard, so the scope is fairly wide. As I said, it's not, you don't have to, it's saying that if you need to apply fair value on other Ind AS, this is what you look at. So when another Ind AS require or permit fair value measurement or disclosures about fair value measurement, okay. However, there are some specific scope exclusions, okay. Initial measurement and subsequent measurement as required by Ind AS, examples, fair value less cost to sell as required under Ind AS 105, fair value through profit and loss account as required under Ind AS 109, property, plant and equipment measured under fair valuation as required under Ind AS 11, as Ind AS 16, biological assets measured at fair value under Ind AS 41. So a number of places in a way where you apply the fair value principles, and there are many more. Some exceptions, which is like share-based payment, Ind AS 102, where you apply a valuation technique, right? Even though it's actually a proxy to fair value, so to say, okay. Similarly, leasing transaction, where you look at a right of use assets, from that perspective. So measurements that have similarities, when you look at again Ind AS 19, right? When you do projected benefit allocation using the actuarial method, right? So those are similarities to fair value, but are not fair value, okay? So net realizable value in the context of Ind AS 2, inventory, or value in use and Ind AS 36, okay? So there are a lot of areas which are where you see, and if you will, and if you remember, let's say if you look at Ind AS 103, where we talked about the business combination standard, right? In the business combination standard, a number of areas which are identified like this: the Ind AS 19, the employee benefit, or the stock options, or inventories. Though inventories needs to be fair valued in the context of business combination, but again, otherwise under the Ind AS 2 guidance, it's net realizable value. It's not fair value, so to say. Certain disclosure exclusions, plan assets, again, in the context of Ind AS 19, I talked about assets for which recoverable amount is fair value less cost of disposal in accordance with Ind AS 36. So these are certain scope exceptions and disclosure exclusion as part of the standard. So what is fair value? Okay, what is the definition of fair value? So fair value is defined as, all right, fair value is defined as an exit price at which I can exit out of this asset. I can sell this asset, okay, or transfer a liability. So fair value is an exit price in an orderly transaction, not under stress, not under duress, not when the markets are not functioning properly, right? In an orderly transaction between market participants. The meaning of market participant is that you as a buyer and a seller, me as a seller, you as a buyer, we both understand the asset. We both understand what we are buying and selling, right? So we have full knowledge of the asset, okay? We have full knowledge of the asset. Fair value is an exit price in an orderly transaction between marketplace participants at measurement date. As I said, right, today the price is 100, tomorrow the price is 120 or maybe 80, right? So the fair value is relevant at a measurement date, right? The price that would be received to sell the asset and the price that would be paid to transfer the liability. So what is fair value? Fair value is an exit price between marketplace participant at a measurement date. And in the context of an asset, the price would be received to sell an asset, and the context of liability, the price which needs to be paid to transfer a liability, right? In that case, not based on how much the reporting entity has to pay, but how much I need to pay to transfer, how much somebody else is willing to take this on. right? Marketplace participant in terms of taking over the liability, right? So this is what it provide guidance on how to measure fair value when required or permitted by specific Ind AS standards, right? When required or permitted by specific Ind AS standards. Okay, so what is fair value? This definition is very, very important, and we're going to talk about each of these components. Okay, the whole standard revolves around this definition. Okay, so fair value is price which is received to sell an asset in an orderly transaction between marketplace participants at a measurement date. That is what is called fair value in the context of an asset. In the context of a liability, fair value which is required to be paid to transfer a liability, right, in an orderly transaction between marketplace participant at a given measurement date. Okay, so that is what is fair value for liability and for asset, and essentially in both cases it is what is called exit price, price at which I can transfer this liability or I can sell this asset. If you can do all of this, that is what is called fair value. Fair value, orderly transaction between marketplace participant at the measurement date, price which is received to sell an asset or paid to transfer a liability. And all of these components, like what's the meaning of the word price, right? In a way, right? So what's the meaning of the market participant, so to say? What's the consequence of related party transaction, so to say? Okay, what's the meaning of the orderly transaction, so to say? All of these is what we will try and try and understand and talk about in a way from that perspective. It does not include transaction cost, does not include transaction cost, though it does include transportation cost, and we will talk about that. Okay, there could be, when you're trying to determine fair value, there could be asset or liability specific restriction, or there could be entity specific restriction. So these are two types of restriction: entity specific restriction or an asset or liability specific restriction. In a way, if a restriction is related to an entity, then that is not to be considered while determining fair value. But when an restriction or on usage, on transfer or anything is related to the asset and liability in itself, that means if you were to transfer this, if you were to sell this to the new buyer or to the new purchaser, in a way, then that restriction in a way moves along with the asset. If the answer to that is yes, then that restriction needs to be factored in while determining the fair value of such assets or liabilities. So restrictions which are asset or liability specific being transferred to the buyer as it is, that needs to be considered. If the restrictions are entity specific, then they are not to be considered while determining the fair value. Entity specific restriction, no. If it is asset liability restriction, then it is to be considered yes in terms of determination of fair value. So what is fair value? Fair value is the exit price, price which is received to sell an asset or paid to transfer a liability in an orderly transaction between marketplace participant at the measurement date. At the measurement date. And if there are entity specific restriction, that you are not required to consider, but if there are asset or liability specific restriction, which in a way part of the asset or liability in question itself, that needs to be considered while determining the fair value. From that perspective, let's look at this example to address this point. Sky Limited is having a land. Owing to its business objective in which it operates, it has current restriction to develop a commercial house on the land. Okay, current restriction, its own business objective, it has current restriction to develop a commercial house on the land. Sky Limited wants to sell the land, and there would not be any restriction for the new buyer to develop a commercial house on the land, right? That means what? This is an entity specific restriction. It's not an asset specific restriction. As the restriction is specific to Sky Limited, it will not be considered while calculating the fair value of the land. Tree Limited, a software company, has certain securities. These securities have been pledged with a bank and restricted to be sold for the next 3 years. In this case, restriction is again specific to Tree Limited and nothing to do with the security, and hence it is not to be considered while determining the fair value of the security. Let's take an example where there are asset and liability specific restrictions. Okay. Mr. Y has bought a yacht for private use. So now we're going to do this example where we have an asset or liability specific restriction. So the last two examples which we saw, there was the entity specific restriction, but no asset or liability specific restriction. So here the example is Mr. Y has bought a yacht for private use, and there is a restriction to not use the yacht for any commercial purpose. The fair value of yacht for commercial purpose is more than the fair value for private. So after talking about entity specific restrictions, now we're going to take an example which talks about the asset specific restriction, and you will clearly see that what we said, that if there's an entity specific restriction, then you ignore that while doing the fair valuation of that asset or a liability. Whereas when it is an asset specific restriction, that means that the restriction in a way will also stay with the new buyer. When you want to exit out of that asset or a liability, it stays with the new buyer. At that point in time, you need to actually factor in the impact of those restrictions while determining the fair value. So the example here is Mr. Y has bought a yacht for private use, and there is a restriction to not use the yacht for any commercial purposes. The fair value of yacht for commercial purpose is more than the fair value for private use. In this scenario, as the restriction to use the yacht by Mr. Y is asset specific, and market participant will also consider the asset specific because you cannot use it for commercial purpose. While calculating fair value for such asset, this condition will be considered while evaluating the fair value of the yacht. Awesome.